Hi friends, good day. Today let us try to understand about what is futures trading, what are the parameters of futures contract, what is futures margin, and what are its advantages and disadvantages through this video. According to Warren Buffett, what the wise do in the beginning, fools do in the end. Before we go in, please subscribe for more videos. Click the bell icon for updates. What is futures? Futures are financial contracts or an agreement that obligate the buyer to buy or the seller to sell a specified quantity of some asset such as a commodity, currency, or stocks for a specific set price regardless of the current market price at a predetermined date in the future, that is the expiration date. Now, what is futures trading? Futures trading is especially common in commodities. For example, if someone purchases a July crude oil futures contract, they are obliged to buy the specified quantity, that is 1,000 barrels of oil, for an agreed price upon the July expiration. They allow the traders to lock in a price of the underlying asset for a commodity. Now, what are the types of futures? There are many types of futures contract available for trading. Commodity futures such as crude oil, natural gas, corn and wheat. Stock index futures such as S&P 500 index. Currency futures including those for the euros and the British pounds. Precious metal futures for silver and gold. US Treasury futures for bonds and other products. Now, what are the parameters of the contract? Each futures contract will specify all the different parameters: the unit of measurement, how the trade will be settled, the specific quantity of goods to be delivered or covered under the contract, the currency unit in which the contract is denominated, the currency in which futures contract is quoted, grade or quality considerations when appropriate. For example, the purity of the metal. Many investors and speculators borrow a substantial amount of money in order to play the futures market because it is the best way to magnify relatively small price movements to potentially create profits that justify the time and the effort. But borrowing the money increases risk. If the market moves against you, and that too at an alarming rate, then you could lose more than what you have invested. Now let's look into futures margin. Futures margin is a deposit or an amount of capital one needs to post or deposit to control the futures contract. Margins in the future market are not down payments like stock margins. Instead, they are the performance bonds designed to ensure that the traders meet their financial obligations. In the world of futures contract, the margin rate is quite low. In a typical futures market, the margin range from 3% to 12% of the total contract value. Marginal maintenance is the amount of money necessary when the loss on a futures position requires you to allocate more funds to return to the initial or original margin levels. What are the advantages of futures contract? Opens the market to investors. They are useful for risk-tolerant investors. Investors get to participate in the market that otherwise they don't have access to. Stable margin requirements. Margin requirements are well established in the futures market. So an investor knows how much margin he should put in the contract. High liquidity, simple pricing, protection against price fluctuations, that is, These can be used as a hedging tool in the industries with high price fluctuations. For example, a farmer with a crop can sell the crops for a fixed price now, for a future date and delivery if he or she expects a price drop. Hedging against future risk. Companies often use these contracts to limit risk that may arise from foreign currency exchange. Disadvantages: no control over future events, price fluctuations and potential reduction in the asset prices as the expiration date approaches. Well, thank you so much for watching. Please like this video and do share.